Investing always carries some level of risk, and the degree of risk typically depends on the type of investment and the market conditions. Some investments are inherently riskier than others, such as stocks, options, and cryptocurrencies, while others like bonds and savings accounts are considered less risky. Before making any investment, it is important to carefully consider the potential risks and rewards. You should also make sure you have a solid understanding of the investment and the market it operates in. It's a good idea to consult with a financial advisor or do thorough research before making any investment decisions. Remember, high-risk investments have the potential to provide high returns, but they also carry a higher risk of losing your investment. It's important to carefully weigh the potential rewards against the potential risks and determine if the investment is suitable for your financial goals and risk tolerance. Identifying the riskiest investment can be subjective and depends on various factors such as market conditions, economic outlook, industry trends, and individual risk tolerance. However, some investments are generally considered to be riskier than others. Investments in individual stocks, especially those in smaller or newer companies, can be very risky as their performance is often dependent on a single company's success or failure. Similarly, options trading and investing in cryptocurrencies such as Bitcoin and Ethereum can be highly volatile and risky due to their fluctuating prices and lack of regulation. Investments in emerging markets and startup companies also carry higher risk due to the possibility of political instability, lack of established infrastructure, and limited access to capital. Ultimately, it's important to carefully assess the risks associated with any investment and ensure that it aligns with your financial goals and risk tolerance. It's a good idea to consult with a financial advisor or do thorough research before making any investment decisions, especially when considering high-risk investments. Investments always carry some degree of risk, but some investments are generally considered riskier than others. These may include stocks of small or new companies. These stocks are often subject to more significant fluctuations in price due to their limited market share, earnings, and financial history. Investing in stocks of small or new companies can be risky due to their limited market share, earnings, and financial history. These stocks may be more susceptible to sudden changes in demand, supply, or consumer preferences, which can lead to significant price fluctuations. Furthermore, small companies may lack the resources or diversification of larger, established companies, making them more vulnerable to market and economic changes. However, small and new companies also have the potential for significant growth and can offer higher returns on investment compared to more established companies. As such, investing in stocks of small or new companies may be suitable for investors with a higher risk tolerance and a long-term investment horizon. Before investing in stocks of small or new companies, it's important to do thorough research and analysis to understand the company's financials, market potential, management team, and competition. Consulting with a financial advisor can also help assess the risks and potential rewards associated with this type of investment. Options trading. Options contracts can be very complex and difficult to understand, making them risky for inexperienced investors. Options trading is a type of derivative investment that can be highly risky due to its complex nature and potential for significant losses. Options give investors the right, but not the obligation, to buy or sell an underlying asset at a specific price within a specific time frame. This can lead to significant profits if the investor correctly predicts the movement of the underlying asset's price, but can also lead to substantial losses if the price moves in the opposite direction. One of the main risks associated with options trading is the potential for unlimited losses, especially when investors use leverage or margin to amplify their investment. The value of options can fluctuate rapidly, and investors must be prepared to lose their entire investment in a short period. Options trading requires a high level of knowledge and experience, as well as a solid understanding of the underlying asset, market trends, and trading strategies. Investors must also closely monitor their investments and be prepared to act quickly in response to market changes. It's important to consult with a financial advisor before investing in options trading and to thoroughly research the risks and potential rewards associated with this type of investment. Cryptocurrencies. The values of cryptocurrencies like Bitcoin and Ethereum can be highly volatile and subject to large swings in value. Cryptocurrencies, such as Bitcoin, Ethereum, and others, can be highly risky investments due to their volatility and lack of regulation. These digital assets can experience rapid and extreme price fluctuations, which can lead to significant losses for investors. Furthermore, cryptocurrencies are not backed by any tangible asset or government, making their value highly subjective. Cryptocurrencies can be subject to a variety of risks, such as hacking, fraud, and regulatory uncertainty. Additionally, the technology and infrastructure supporting cryptocurrencies are still in their early stages of development, which can create further uncertainties. However, investing in cryptocurrencies can also offer potential high returns on investment, especially for those who invested early in the market. As with any investment, it's important to carefully consider the risks and rewards associated with investing in cryptocurrencies and to consult with a financial advisor before making any investment decisions. Investors must also closely monitor their investments and be prepared to act quickly in response to market changes. Additionally, investors should ensure they understand the technology behind cryptocurrencies and the associated risks of investing in a new and evolving market. Emerging markets. Investments in countries with emerging economies, such as China or India, can be risky due to political instability, limited infrastructure, and currency fluctuations. Investing in emerging markets can be risky due to their political instability, lack of established infrastructure, and currency fluctuations. Emerging markets typically refer to countries with developing economies, such as China, India, Brazil, and others. Emerging markets often have higher growth potential than developed markets, but they also come with higher risk. Political instability, such as sudden changes in government or civil unrest, can create economic uncertainty and disrupt investments. Additionally, the lack of established infrastructure and institutions, such as reliable transportation systems and stable financial markets, can create additional risks. Currency fluctuations can also pose risks for investors in emerging markets. Fluctuations in exchange rates can impact investment returns, as the value of investments denominated in a foreign currency can rise or fall depending on the exchange rate. However, investing in emerging markets can also offer potential high returns on investment, especially for those who invest in the right companies or industries. As with any investment, it's important to carefully consider the risks and rewards associated with investing in emerging markets and to consult with a financial advisor before making any investment decisions. Investors must also closely monitor their investments and stay informed about economic and political developments in the countries they invest in. Diversification and investing in a broad range of emerging market investments can help mitigate some of the risks associated with this type of investment. Startup companies. Investing in new or untested companies carries a high degree of risk since there may be limited information about their financials and potential for success. Investing in startup companies can be risky due to their limited financial history, untested business models, and high failure rates. Startups are typically new companies with innovative ideas, products, or services, which can make them attractive to investors seeking high growth opportunities. However, startups often have limited financial resources and may lack the experience or infrastructure necessary to succeed in a competitive market. As a result, they may be vulnerable to market changes and more likely to fail than established companies. Investing in startup companies also carries the risk of significant losses, as many startups fail to generate revenue or make a profit. Investors may have to wait years before seeing any returns on their investment, if at all. Despite the risks, investing in startup companies can also offer the potential for high returns on investment. Successful startups can experience rapid growth and may be acquired by larger companies or become publicly traded, providing significant returns for early investors. Before investing in startup companies, it's important to carefully evaluate the company's business plan, management team, financials, and competition. Consulting with a financial advisor can also help assess the risks and potential rewards associated with this type of investment. Diversification and investing in a portfolio of startup companies can help mitigate some of the risks associated with investing in a single startup. It's important to understand the risks associated with any investment and to assess whether it aligns with your financial goals and risk tolerance. Consulting with a financial advisor and conducting thorough research can help mitigate some of the risks associated with high-risk investments. That is it for today's video. Please comment down below with your insights and ideas. To learn more about business, life, and technology, subscribe to this channel, and we'll see you on our next video.